Welcome to MRG Wealth's Personal CFO series, sharing knowledge and solutions to make your journey unstoppable. Today we're going to be talking about alternative investments. What are they? What's the benefits and risks? And why should you care? And today we have a special guest on the show, Robert Janson, co-CEO of Westcourt Capital and Chief Investment Officer. Welcome, Rob.
Good to see you.
Thanks for coming on today.
Bet.
So what makes Westcourt a leader in alternative investments in Canada?
Mostly it's 16 years of hard work, basically trying to get the message out that Canadians should have exposure to alternatives. So I was originally a portfolio manager for the big Swiss bank UBS in Switzerland. My business partner is a lawyer by trade. He came up through private equity and real estate. And when we came together to co-run as co-CEOs the firm, and this is rewinding back about 15 years ago, there was a need that we saw in the Canadian marketplace. So my exposure, again, I'd had insight into portfolio management in Europe, looking at the way the largest families manage money, et cetera. And again, David had that private equity and real estate lens. When you put it all together, we recognized that there was an enormous need coming out of the GFC, the global financial crisis at the time, which seems like eons ago, that there was no one sitting on the side of families helping them to make decisions regarding portfolio construction, portfolio management in the world of alternatives. And 15 years ago, the connotation or the word of alternatives either connoted risk, or there was some opacity, or there was an unknown, or they weren't good, you should keep away from them. The world has slowly changed, and I can give you some of the stats in a couple of minutes just with regards to how many trillions with a T are actually going to alternatives. So where are we right now? We've been, again, cutting our wake in the world of alternatives based out of Toronto, and we obviously do business across the country, managing money for some of the largest families in Canada. So largest portfolios are about 10 of them are north of $100 million, one being $400 million. And it's, to have access to, we'll get into this, they're not necessarily catchphrases, but private equity, private debt, real estate, hedge funds when appropriate, but simple things as well, like real assets, infrastructure, self-storage, apartments, farmland, et cetera. So we like to approach alternatives by way of trying to keep it simple. We think that's most appropriate for people who are trying to digest something new. But yeah, we've had great success managing those assets for families with 40 people at the firm.
Amazing.
Yeah. And
maybe let's unpack what is an alternative investment. You listed a few examples. What makes that an alternative investment, or what is an alternative investment classification?
It's definitely a broad definition. It's kind of like when people say, what's a family office? It depends on who's going to actually define it, because there's nothing in the dictionary that says alternatives are. They used to be called non-traditional asset classes and tax. And that's really anything which is investable, which simply falls outside of the realm of public stocks, meaning the stock market, buying stocks, and bonds. So again, the concept of real estate, even real estate, now there are publicly traded REITs, I think we're going to get into that a little bit, but if you have exposure to a private REIT, again, that would be considered alternative. So again, it's depending, you could have a sports trading card collection would be very alternative. Clearly, if it was a collection that was worth anything, or even a wine collection or an art collection, those are sort of the fringe of what alternative investments could be. But again, it's become so mainstream now. When I talk about the big ones of private equity and private debt, and real estate and real assets. Real assets are things you can touch and feel. Again, that stat is there's about $1.5 trillion between high net worth individuals and institutional clients putting money per year, $1.5 trillion going into the world of alternatives, simply because, again, let's say the biggest institutions in the world have their buckets full of stocks and bonds. What else is there to invest in? They have the balance sheet that they could go and buy, a toll road in New Zealand or an airport in Hong Kong. Those are obviously big investments and big alternative investments. But bringing it back home, it's how does a Canadian sort of have access to that? It can be palatable and easy actually now.
Yeah, and you mentioned alternatives, the space growing at about $1.5 trillion per year. When we look at a global or macro perspective of stock and bond approach versus some of these alternatives that you mentioned, what do you see in terms of current growth rates of institutions and ultra high net worth people putting into the stock market versus putting into some qualified alternative investments?
Well, this is some of these stats I love. So we've done some work at the firm, and we've recognized that the peak number of public companies on the U.S. exchange, which is the biggest in the world, whereas about just north of 8,000 public companies. That was in 1996. Since then, so there's been an erosion in the number of companies. Now, of course, there's the size of companies because we have 7 companies that are $1 trillion in market cap each. But the number of companies has gone from about 8,000 to 4,000. I'm rounding, but literally a loss of 50% of the companies. So again, one would suggest, and remember what people are trying to do in the public markets. You're trying to do analysis of, is that stock undervalued or overvalued? And you take a look at the world that we live in with CNBC on and instant information and the internet and how many analysts are looking at it, it's very difficult to have an edge. So you might have 300 or 500 or 1,000 analysts looking at the same stock. It's difficult really to have that edge. So it's one, again, needs stock and bond exposure in the portfolio, but is there a place to allocate monies which is less efficient? And again, coming up on stats, there are about 1.9 million private companies in the United States with over 50 employees.
Wow, that's staggering compared to
staggering.
4,000
Exactly.
stocks.
And so remember, so there's about 4,200 stocks that are public and 1.9 million that are solid private companies. So the math is there's about 425 times more private companies to look at than public companies. So again, one would simply say, and you don't have to be a mathematician or work in finance to say, if I was going out to try and find a diamond in the rough or a jewel or a needle in the haystack, well, I have simply more companies to look at. Then if you look at the number of companies in the United States that have over $100 million of revenue, and then the number of companies in Europe that have over $100 million of revenue that are public or private. In the U.S., I think it's about 13% of companies with over 100 million of revenue are public, and 87% are private. And that's in the U.S. because you think it's a more efficient market. There's a lot more competition in finance. In Europe, it's even more pronounced. It's about 4% are public and 96% are private.
That's a compelling argument right there.
Yeah, you've got an enormous pool of opportunity in front of you with obviously a lot of dollars to be allocated. But that's in the world of private equity. And again, the differentiation between public versus private equity. They're both equity risk. You can really think about it. If there was going to be a $1 billion company bought in the private markets, it just happens to not be public. It's the exact same. At the end of the day, it's the exact same company. Now, what they're trading for on the public markets might be different than what they're worth. That's a topic unto itself. But again, they are the same company. So it's an interesting fact that the world is changing a little bit because there's trillions of dollars flowing into, again, the private markets.
And great segue into maybe what are some of the benefits of an alternative investment? You talked about size and scale and just even the amount of opportunity out there. But why would Canadian maybe want to look at having alternative investment exposure in their portfolio? What's some of the benefits that some of the high quality alternative investments have provided clients in the past?
First and foremost, it's ballast, right? Because there is no magic wand, and there's certainly no crystal ball to understand which way the world is going to go. If not, we'd all be living on an island because it would be easy to make those investment decisions. But the ballast in the portfolio is provided by simply having more arrows in the quiver. That's the greatest analogy, is that if you only have 2 arrows being stocks and bonds, it's difficult to win that fight. If you have 8 or 10 different return drivers, I think that's going to help the portfolio because most importantly, you should be having exposure to alternatives that might be less correlated to the public market. So let's take April as an example. Obviously, with Liberation Day, you see the stock market plunge, and let's just say the S&P 500 is down at its nadir is minus 15. The minus 15 on the public stock market didn't have a lot to do with what rent collections are doing here and maybe in Western Canada when you're talking about a private REIT that has 25,000 apartments. So again, you have a differentiated sort of push-pull or risk-reward drivers. And when you put that all together, if you've got less correlation between the constituents in your portfolio, it just makes for a smoother ride. So
and what do you mean by correlation? Let's unpack that.
Yeah, no, it's great. I mean, correlation is best described as going in the same direction at the same time. So better said is, again, if my example was the stock market was down 15% and equally that REIT in the world of alternatives was repriced negatively at exactly the same time, it would be a little bit redundant in your portfolio. Now, if, again, that private REIT in my example was to hold its value, because, again, there was nothing wrong with collecting the rents, that obviously is an offset to some of the negativity that you had in the public markets. And the combination is when you have exposure to all these different asset classes, it just simply makes that a portfolio with alternatives in it was likely down less in April than the minus 15 in my example. It doesn't mean that it's, again, a complete shield, but at the same time, if a portfolio not being down minus 15 was down 1 or 2%, I think it's more palatable for clients and certainly for Canadians who would say, I'd rather the minus 2 than the minus 15.
Absolutely.
Live to fight another day.
Or even positive.
Yeah.
There's a number of
Even
the
positive,
alternative
definitely.
investments that I've seen that were positive
Yes,
in April
definitely.
and still generating growth and cash flow. And that leads to the diversification gap I think a lot of Canadians have. A lot of individuals I meet, talk about diversification, or their advisors, preaching diversification. Yet when you look at the portfolio, it's still stocks and bonds. And diversification, I think, can mean different things to different people. And what you just described was asset class diversification, like looking at equity or the public markets as one asset class. You could have private real estate as potentially another asset class. You could have private equity as another asset class, private debt, storage facilities, farmland, to diversify that out. And I think that's one of the big takeaways from anyone watching. When you're looking at diversification doesn't come from purely just staying in one asset class.
And I think we've seen that, is that what we found in our travels is it's often the Canadian entrepreneur who might have money, and I'm going to pick on the banks a little bit, who might have money at the banks, who have, I think, done a poor job in the interests of Canadians, a great job in their best interest to have everybody invested in a very similar manner. Stocks and bonds, which again dominated the 80s and 90s and the beginning of the 2000s before these other concepts came about. I think that makes it a little bit more difficult. The entrepreneur who either maybe sells their company, has come into money, maybe inherits some money, we've seen a trend that is simply, they've had their head down, they've been working really hard, they've been working hard for their family, etc. They've made a little bit of money, but maybe they sold their company, they come up for air and they simply say, what else is out there? And so when people go and do a little bit of their own research, because again, it is their money, they should have a general understanding about the concepts of what and how their portfolio is built with a professional and an expert advisor. I think it's important because it's the curiosity, I think, of that type of entrepreneur, which will lead to, I don't want the portfolio of my parents or the way it was built in the 1980s being simply those stocks and bonds. And again, the world of alternatives is not yes or no. You can take it slow. You can do things that a client can understand. When we talked about apartments, or we talked about farmland, or we talked about self-storage, these are all concepts that everybody can wrap their head around, and certainly a business person as well if they've been running their own business, as opposed to an esoteric or very complicated hedge fund, or even a public company doing something very complicated in the world of technology, etc. So yeah, the world of alts can be baby steps for sure.
Absolutely. That's a good point. I think regardless of the investment portfolio of the individual, it's really important to understand what is your money actually invested in.
Right.
Like, how do you make money and how do you lose money, and how is that strategy coming together for you?
Yeah.
So, one of the benefits we talked about was diversification across the asset classes. What about some of the other benefits that alternative investments have provided in the past, maybe around tax or consistency?
I think tax efficiency is a huge one. One of the last bastions of tax efficiency in Canada, ex having simply the use of an RSP or a TFSA, is, and we don't need to get too technical on why, but any sort of distribution that is paid from real estate, if we use them, that asset class as an example, can come back in a very tax efficient manner. So again, whether it be the characterization of a blend of sort of, it could be capital gains, but mostly ROC, return of capital, X the technicalities, that is a distribution that could either be reinvested, it could be used, it could be spent, it could be eaten. And again, it's a deferral of tax that exists, obviously, for Canadian investors. So the world of alts can have not only the benefits of that diversification, as you said, it can have the buffer for the portfolio in difficult times. How many Canadians and how many clients are really looking for tax efficient cash flow to begin with? People need something to live on. But again, if let's say the bonds are not doing the job, how else can we generate that? Well, even better if it's tax efficient as well, because tax as fully income would be a little bit of a tougher pill to swallow, and if there's tax efficiency to be had, all the better.
Absolutely. Yeah. Kind of the core pieces of business as you look at increasing revenue and decreasing expenses, right?
Perfectly put.
So when you're looking at a personal portfolio, your growth rate is one area that's really important. But I find a lot of Canadians also forget to look at what is their tax rate on the investments and how is that grinding down their wealth. It can make a significant difference in their overall wealth, being able to achieve their goals, whether it be financial freedom or
Well,
what
I
that
know
looks
you're
like.
passionate about that, and so are we. It's so rare, and I'm not sure why in this country, is that it really irks me to see a proposal, maybe from a competitor or a bank, and they say, here's your expected return. Please seek tax advice. We're not here to give tax advice. Please seek tax advice from your tax expert to understand what your net return should be. We sort of throw that out the window. I think an advisor, and I know that you do this type of work when you do planning, et cetera, you have to understand what your after-tax rates of return
Absolutely.
look like. They might not be perfect, but I think there has to be a general notion to it, which is important, because if clients are doing any sort of planning or any belief and understanding of where they're going to be in 1, 3, 5, or 50 years, again, unfortunately, there's a third party in the relationship, advisor client. Well, there's also the CRA and obviously the government who is interested in those returns as well. That's just a fact of life. So it's better to understand what type of tax you're going to be paying.
Absolutely. And the end state for the kind of investor, they want to understand like what's in their pockets. Like what do they actually make after they have to pay CRA? Like what can I spend?
It's a rarity
right?
in Canada to see that, right?
Absolutely. It's one of the big challenges I find that a lot of Canadians have that we create solutions for. Prime example is throughout COVID, there was a lot of GIC rates that were advertised, whether promotional or not, in that 4 or 5%. I remember having a number of conversations with individuals that are looking to invest in their corporate accounts or their high tax individuals and thinking that 4%'s low risk, good return, and then you break it down and you're like, okay, your after tax rate's more around 2. Are you happy with that? And they're like, well, no, inflation's at 7.
Oh, yeah.
Why do I want to make 2? We're like, okay, well, let's look at the whole picture when you're looking at an investment.
Right. And I always brought this up, is that you arguably can't beat inflation, or at least it would be very, very difficult to beat inflation. At best, you could keep up with it. And so do you think the banks are there to give you a rate of return on cash that is going to keep up with or beat inflation? No. Again, they're paying 4%. You lose half of it to tax, and again, you're being doubled by the rate of inflation. You are eroding your purchasing power, unfortunately. So cash became an asset class, I think, for the better part of a year and a half. When rates were 0, everybody wanted their money to work. Obviously, interest rates climbed. Everybody wanted to leave their money in cash, and now we're sort of on that, sliding down the other side of the tail of that. I think rates will be cut again soon, and again, people are going to want their money back to work to work and earn for them.
And inflation is a great thing that a lot of people forget to think about, is you need to at least be building out your strategy to manage the inflation risk that everybody has.
Right.
The old adage of like even just putting money under the mattress, people forget, well, if you do that, beside the fire risk and every other risk that you have, you're losing money every day.
But I think that's why people should work with a sophisticated advisor like yourself. It's that it's frustrating to understand or to have an idea or a glimpse into how misunderstood inflation is in Canada. And so, you've got a bag of oranges or your 10 bananas that you're going to buy. People believe that when inflation subsides, prices are going to go back down. It's basically no. If inflation stays normalized between 1% and 3%, we're at a new normal.
Yeah.
So again, you need to have wage inflation to come with it. But again, I think it's a big element that needs greater teachings, I would say, in Canada with regards to inflation and how it affects the everyday Canadian, for sure.
Absolutely. So we talked about diversification of the asset classes and how that can help. We talked about tax efficiencies. Let's maybe talk about sequence of returns, because that can create a lot of havoc for individuals. And what I mean by sequence of returns is, the roller coaster ride of what the stock market is. Yep. And, history's laid out. You have times where the stock market goes up, and you have the times where the stock market goes down. And then over time, quality companies in the public stock market have generated value for clients. But over a 5, 10, 15, 20-year period, you don't know what year, what period is going to be up or down. And that sequence that happens in your portfolio can drastically affect when you can retire or, how you achieve your other goals. So how do alternatives play, in that space of sequence returns and helping an individual be able to map out their cash flow and growth a little better?
I think it's an excellent question because, one, people have very short memories. So people have long forgotten the global financial crisis, that's for sure. The most recent, I would say, period of tumult was certainly April, right? But if you open up your statement at the end of March and then at the beginning of May, you might not have even known that markets corrected. But the biggest one is 2022, where markets were down maybe 20%. And so I think first and foremost between 2009 to, call it 2019, at least COVID, there's an enormous amount of complacency. It was very easy to invest. It was that you bought an ETF, you didn't need an advisor, and markets kept going up and to the right because it was low inflation, low cost of debt. Markets corrected and snapped back very quickly. That's not normal. It might have been the greatest bull run or the greatest sort of positive run for the stock market those 10 years that we might see for the next 50. The more normalized is there's a war. Oh, geez, there's a second war that breaks out. Valuations are too high. China and Taiwan. Oh, we've got a U.S. election. Oh, inflation is still sticky. These are the more normalized things that, again, unfortunately, has the stock market ebb and flow, that you could be up 25% a year or you could be down 25% a year. So at our firm, and why clients have gravitated towards our way of thinking, and I know that you do as well, is that we'd rather narrow the guardrails of volatility, right? Actually, at our firm, if someone walks in and says, well, I'd like to make 20% a year, we would say, you're not the client for us. Most clients, with regards to how they want to achieve their returns, how much is enough is somewhat in the rearview mirror, right? They're trying to save for retirement. They're trying to build on that. They're trying to better their life. But at the same time, if you could narrow that volatility, which gives you a better idea with regards to the planning, right? Let's try and make a rate of return somewhere between 7 and 9% in most, if not all, environments. Maybe 1 year will be 5, maybe 1 year will be 4, maybe 1 year will be 11, but it won't be plus 25 and minus 25. So we found this for a client, a smaller client, all the way up to the largest clients that we have. It is a our expected rates, our goal for our portfolios is really the expected rate of return of what we're trying to build around. And so it's not so much crossing our fingers and hoping the stock market continues to go up. I mean, I was the first to say that after 2022, when it was down minus 20, the S&P 500 was up 25% in 2023 and up 25% in 2024. So just for context, if you had taken those 2 years in isolation, up 25 and up 25, if you had a third year of up 25, the stock market would have doubled in a 3-year period. That doesn't seem normal, just in saying that. And again, you don't have to be having worked in finance or other. People would say, well, did the value of the companies go up twofold in the space of 3 years? So people are saying, did we get ahead of ourselves? Is the stock market going to stumble? Now, it looked like our neighbors to the south, ensured that, yes, there was a bit of a downturn in April. But again, coming back to your point, it's basically to, again, narrow those guardrails of volatility and hopefully have a more defined outcome.
Yeah, and I love that you talked about how that 2009 to that 10-year period might be some of the golden years or the golden decade of investing. And a lot of people forgot what the 10 years prior to that was. Mm-hmm. So we're not too far ago. Like we're 2000 to 2010, and using the S&P 500 just as the largest stock market in the world again, average return for that 10-year period was minus 1%.
Right.
And so many people either forgot about it or weren't heavily invested at that time. Right. And there's like you said, a complacency effect, thinking about, okay, the last 10 years is what I think the next 10 years should be. And if you read most disclaimers in any investment and you're talking to any advisor, they should be talking about past history doesn't equal future returns. Right. An important lesson.
Well, we always like to say as well is that if you go back and you can Google this, it's like, what are the rates of return for the S&P 500? You can pick it from 1950 to today, 75 years. The stock market, let's just pick the S&P 500, the U.S., which is the biggest and broadest and deepest stock market. It averaged about 9.5%. So if a client is to come into us and say, I need to make 15% a year, we would sort of say, well, what makes you so special that you believe that you could out-earn, right, on a performance basis, by 5 or 6% better than the S&P 500, but certainly if you take a look at the biggest professional investors in the world, the biggest pension funds, the biggest family offices, again, you can have outsized returns, clearly, for a couple of years, but then they normally come back and there's some mean reversion and they come back to normal a bit. So again, it's also setting expectations for clients and understanding that, again, we've been fortunate, and if you can annualize 9% for 15 years and narrowing those guardrails of volatility, a lot of people are willing to sort of sign on to that concept.
Absolutely. If you knew with greater certainty from a planning perspective and say, okay, if I get a bonus or an inheritance, mm-hmm. or I sell my company and I have a large chunk of money to put in, one of the biggest concerns many Canadians have is, well, what happens if this is going to be a negative year in the market, right? I don't want to be on that minus 25 year when I put in a large chunk of capital.
Or preparing for retirement. And the year you go to retire, you have a minus 25 and you say, oh, I've got to push this off by a year or two. I mean, that would be a horrible existence to sort of say, oh, I was ready to go, I was ready to finally hang it up, and then you've got to work a couple more years. Exactly.
Absolutely. So on the consistency area for alternative investments, where some of those quality investments we've seen working with the clients, they haven't seen a negative year yet in a lot of those areas. And like you mentioned, they might not always be the exact same number, but you don't have the plus 25, minus 25. Seeing a positive number of growth and cash flow is really helpful in planning.
Right, and that is the deal, is that there has to be a trade-off. It can't be, it's not the perfect product, and mostly it is. Would you rather make a reasonable rate of return and give up the big swings? Yes, so sign on. And the second is we can talk a little bit about liquidity as well, because again, those are the trade-offs sometimes for alternatives, right?
Yeah, maybe let's jump into the risks, because every investment has risks. There's no free lunch in the world. So what are some of the risks that people need to be aware of alternative investments?
I think it is. The biggest thing to avoid is the opacity, the opaque nature of alternatives. And again, if the advisor can't explain it or you can't understand it, you can take a pass. I mean, it is interesting that I think coming out of 2008, and when you look back at how many sort of really complicated, esoteric investment solutions and products and hedge funds and black box strategies there were in 2008, and a lot of those didn't work through 2008. So many people, I think, hit the big reset button and say, we don't need complexity. We want to understand what we're investing in. And so that's a big one. Avoid the big words, people speaking over your head, the lack of understanding in it, because again, we talked about it before, clients should understand what they're investing in and the opacity that comes with it. The second is the trade-off is normally there is some level of illiquidity with alternatives. Now, it can be very simply that you can get in and get out on a monthly basis, which is different than obviously the stock market. One keystroke and you could sell or buy, or you can get into really illiquid, which is longer dated private equity, might be a 10-year fund. So that's really on the far end. So it's an understanding of liquidity or the parameters that make up the liquidity of fund that you're going to invest in. But again, if you're in a well-diversified portfolio, you've got a percentage in alternatives, you've got a large percentage in the public markets being those stocks and bonds, you still have liquidity in your portfolio. And again, I would hope that no client would say, well, I might need all my money back sometime in the future, whether it be a week, a month, a quarter, a year, or 3 years. It's very difficult as an advisor, but it's very difficult for a person to plan if they think they're going to go and spend all their money from one day to the next. So we think that alternatives and that the acceptance of the illiquidity is something that you can benefit from, in that tranche of the portfolio.
Yeah, I think it's really important when you're working with your advisor and building out your plan to talk about what portions of your money you need when. Right. So if you do need a large portion of your money, to your point, usually it's not like, hey, I'm going to liquidate everything in 6 days. Right. They quite often need that to live. But if there's a piece where you're buying a vacation property or investing in the company or whatever have you, building out the strategy specifically for those liquidity needs can solve that area. Mm-hmm. The other area I love that you talked about is the different liquidity aspects of alternatives. Right. You can have alternatives that have liquidity within 2 days, 3 months, or years, right? And building that into the strategy as well. And quite often when talking about liquidity with individuals, it's important for them to understand, but it's also important to understand most Canadians don't have full liquidity in their lives anyway. If you have an RSP, if you have a LIRA, if you have all these like registered retirement accounts, even if you sold everything from cash and brought it out, you're going to lose almost half of it or potentially half of it in tax anyway. So most people are not looking at full liquidity in a very short period of time.
There's an example that we always see at the banks is bond portfolios can display certain levels of volatility. Same thing, if the stock market's going down, your bond portfolio might be correlated, this is the word that we use, it might be dropping at the same time. People will often say, yes, but if I hold my bond to maturity, or the number of bonds that they have, well, I'll be paid back 100 cents on the dollar, which is true. But what you've done is that you've actually fallen into a trap of actually why you should contemplate not investing in bonds, because you've taken a very liquid instrument in your portfolio and you've mentally rendered it illiquid. Absolutely. So I'm going to take this bond. Yeah, there's 3 years left on it. Yes, it's going to jump around a bit, but so long as I hold it till the end, I'm going to be paid back 100 cents on the dollar. And we're thinking, our thesis is, if you're willing to now accept the 3-year illiquidity on that bond that you've given as an example, is there something better out there? And coupled with liquidity is the illiquidity premium, or the premium you should be paid for tying up your money. If not, you wouldn't do it.
Absolutely.
Right? You wouldn't invest in something that ties up your money for 3 years if you had the exact same return as the public bond that you could sell instantly. So if there is the ability to make marginally an incremental supplementary gain of 1 or 2 or 3% a year because you accepted that illiquidity, should you not be studying that? So again, we've seen clients fall into the trap of explaining it back to us, and they've never thought about it in that manner. That's all.
Yeah, I think that's such a big importance too of financial planning or building out an actual strategy with the client. What about due diligence? So when we think of alternatives, you shared early on that alternatives can really be a variety of different investments. You could have a multi-billion-dollar private real estate fund with thousands of doors and reducing risk that ways, or you could have a mom-and-pop car wash for a couple $100,000. They're technically both alternative investments. Correct. So how does due diligence and the importance of working with a firm, an advisor that does proper due diligence, how important is that for Canadians?
I think it is the differentiator for sure, because there's a DIY aspect that should be avoided in the world of alternatives, and arguably, hopefully, should be avoided in the world of investing, X maybe buying an ETF. So if they're working with you, sophisticated advisor who's first and foremost curious about it, and then relying on maybe partners who have the equal expertise, curiosity, energy, and team to be able to do the work. So we have 40 people at the firm. We've got 12 to 13 dedicated people who are working full-time on these types of files to understand not only when we're sourcing a new investment, due diligencing it, maybe structuring it, so there's a lot of legal work into it, investing in and then monitoring it. Due diligence not only extends to the beginning and when you're making to look a sound investment decision in the beginning, but it's most important as well, after your first dollar goes in, it's the monitoring of it thereafter. So I'll give you another example. We're talking about a private apartment REIT, Western Canadian private apartment REIT. Again, 25,000 doors. Our file might be into the 4,000 or 5,000 hours of work on that file. Why? Because it's ever evolving. When they go and buy a new asset package and they buy 500 new apartments somewhere in North America, we need to understand what it is. Then we need to look at the profile of the fund. How has it changed their metrics with regards to the debt that they have, the lending value that they've secured, the balance sheet, where it is, how they're running it. And these questions just continue on and on. You're on a treadmill thereafter. So
life is always changing, economics are always changing,
exactly,
politics
the
are
world's
always changing.
Exactly. So if you rest on your laurels in the world of investing, buyer beware, and certainly in the alternative space, if you rest on your laurels and think you've got everything figured out, we wake up every day thinking the sky is falling and what more work can we do? And I think that's what you want from a sophisticated advisor is essentially that you're perpetually in a learning mode, for sure.
Absolutely. Thanks for sharing that. And early on in this conversation, we talked a little bit about how kind of the ultra wealthy families and institutions invest a little differently than how the average Canadian invests. Quite often I see, and I've seen hundreds of cases of this, I'm sure you have as well, average Canadians still invested just in stocks and bonds. Yep. Now, you've done a lot of research too in terms of how institutions and, of course, ultra high net worth families invest. Can you talk a little bit about maybe using institutions as an example, like Canada Pension Plan? Is this is an alternative investment style, maybe unique to just a specific group of people, or are institutions and kind of leaders in kind of world economics starting to focus more on alternatives as well?
No, because that stat that I gave, being $1.5 trillion going into alts, that's predominantly the institutional investors. So these are the big pension funds like Canadian Pension Plan or AIMCO, BCIMC, Ontario Teachers. They're called the Maple 8 actually on the world stage. Is that Canadian pensions are very well known for the avant-garde nature to which they're investing dollars. If you take a look at it, but then you get into big U.S. university endowments. So taking CPPIB or taking Yale University, or there's also a peer high net worth sharing group in the United States called Tiger 21. You need to have a minimum of $10 million. There's chapters all over the United States, and they sit around and they talk about essentially investing. They have to defend their own portfolio, and again, it's a peer sharing network for high net worth. If you look at any one of those, so I've taken a big pension, I've taken a U.S. endowment, and I've taken high net worth in the United States. Every single one of those groups has about 60% invested in alts. So I think that's a very eye-opening statistic when, again, they might have heard from the banks, if I'm going to pick on them again, that being invested in stocks and bonds is maybe in the best interest of the banks, but maybe not in the client's best interest. So it's, why should we not try and take a card out of the investing booklet or playbook of the biggest investors in the world and try and have some exposures like the biggest investors? Why are they doing it? Again, it comes back to the whole reason of diversification. Again, we're talking about multi-billion dollar portfolios, but again, and they need to be invested globally. But again, it is invested about 60% into alternatives.
Yeah, and that's on the institution side, and stark contrast from 0% maybe alts a lot of Canadians to 60%, and not advising that these percentages are the right for the individual. They need to speak to their advisor on it. But there's a big contrast. Like, you can see how the wealthy are investing very differently than the average Canadian. Now, that's not an institutional level, quite often the $1 billion space. What about Tiger 21 and some of the ultra high net worth individuals, in the $10 million plus space? Is their portfolios that they're sharing similar to those institutions, or are they more similar to the average Canadian?
No, they're definitely more akin to the big institutions. I mean, one of my colleagues says it best, is that it's only in Canada that we're still asking the question, why alts? That's been asked and answered 20 years ago outside of our borders. It's sort of like how alts, or what type of alts, right? Yeah. It's past the bar long ago that, why alternatives? Again, we're so bank dominated in Canada, unfortunately, that it's a very antiquated way of looking at things in portfolio construction. So we're still battling with the question of why alts. That will dissipate as well, probably in the coming years. But yes, the high net worth of the 10 million plus crowd are trying as well to have their portfolio resemble more of the biggest pension funds in the world, for sure, unless the retail just stocks and bonds 60-40 portfolio.
I think that's an important question for everyone watching. Think about your own portfolio, and if you're in the area of what many Canadians are, where you're really just stocks, bonds, and that could be the form of mutual funds or ETFs as well. Think about, why is this constructed that way? Why is your advisor suggesting that? Is that the best for you? Or if you're doing it yourself, why haven't you looked at maybe diversifying into different asset classes to reduce some of those risks and get some of the benefits we talked about? So I think that's a really good, just reflection question for individuals watching. And maybe, this was an amazing conversation. I really appreciate your background and experience in alts. We've worked together for a number of years, and we integrate alts heavily with our clients to help with the benefits of, diversification across asset classes, reducing the tax burden on clients, smoothing out the return profile. So, when we had April, for example, this year happen, we didn't have clients worried about their portfolio. So
there's a sleep at night-ness to it, for sure.
Absolutely. So if anyone watching does have questions, please reach out. I always share with clients and people, unanswered questions often leads to costly mistakes. So get answers to your questions. Feel free to schedule a call with me directly at mrgwealth.com. And I thank you for watching. Rob, thank you so much for your time today. I appreciate it. And have a great day, everyone.
Thanks very much.